Now I wanted to do another little ratio workshop, Sharpe Ratio workshop. When we did this first workshop on the Sharpe Ratio, this is kind of the continuation of it. This is going to be a little bit more abstract, a little bit more mathematical, but hopefully still interesting. It's supposed to be pretty engaging. There are some Q&A components come with using the Sharpe Ratio. Hopefully this will make it make a little bit more sense. This is also tied to chapter 1 of the book. So if you have the book, The Unlucky Investor's Guide to Options Trading, and you want something to reference, you can go ahead and check that out as well. That's kind of what this ties into. Okay, so a little bit of a recap and kind of like summarizes the conclusions of that last segment that we did. But the Sharpe Ratio is one of the most popular measures for stock or portfolio risk-adjusted returns or excess returns relative to some benchmark. And the Sharpe Ratio gives us an estimate for the expected performance from recent historical data, which is, I mean, great. If you're just looking at the performance of a stock, you could be missing out potentially on the amount of risk that you're taking by trading that compared to something else. Like 2 stocks might have returned 30% in the year, but one might have had double the volatility of the other. So you might be more inclined to trade the one that's lower volatility, a little bit less uncertainty around that measurement, and invest according to that, I guess. And the way that the Sharpe Ratio is calculated is actually pretty intuitive. It's pretty straightforward to do using historical returns, which is part of why it's so like ubiquitously used. But the way that we calculate it is by subtracting the annual expected return of the asset from the risk-free rate, which is usually between like 3 and 5%. You would use the 10-year treasury notes to sort of estimate that. And then you divide it by the annualized returns standard deviation. And the segment that we did before talks about that calculation in a little bit more detail and how to sort of do it yourself. Make sense?
Yes.
So in that segment, we covered a lot of the drawbacks about using the Sharpe Ratio, but the one that I want to focus on is how it defines risk. Because remember that the Sharpe Ratio looks at risk-adjusted reward for an asset. So the way that we define risk in this context is using the standard deviation of returns. That's actually in many ways a great way to measure risk. But what we know from trading is that risk is a very multidimensional concept that standard deviation does not completely summarize. That would be like if you were estimating the risk of an option just using implied volatility. And we can know how detrimental that can be, right? So as a result of how we define risk in this context, the Sharpe Ratio can be highly misleading for more complex instruments or portfolios. And I kind of wanted to show some examples of why. So that's the biggest drawback of using the Sharpe Ratio, which is like how we define risk. And there's not really like a one-size-fits-all way to define risk. There's many different ways to define risk. That's why we have so many different Greeks when we trade options, for example. And that's why even like stock traders will have a bunch of different ways to assess risk. You can't really assess it with one nice, neat number. And this should hopefully explain why a little bit. But yes, make sense?
Yep.
Great. Okay, so the normal distribution. So the Black-Scholes model assumes that stock prices follow a geometric Brownian motion, which can make you sound very fancy at parties with constant drift and volatility. So now you can whip out your geometric Brownian motion when you're hitting up the ladies. But the consequence of this, you don't really need to understand so much like exactly what geometric Brownian motion is. But a consequence of this assumption is that stock prices are assumed to be log normally distributed with log returns that are normally distributed. And in this context, we're talking about the normal distribution, which means something very specific. When we have the center of the distribution and look on one standard deviation of that center, 68% of those occurrences should fall symmetrically on either side of the mean. When we look 2 standard deviations out, that's 95% of the occurrences. When we look at 3 standard deviations out, that's 99.7% of the occurrences. And this model, this distribution, is really, really, really important in finance and in trading. This is where a lot of our assumptions around probabilities come from. And what we find in practice is that very, very often, nothing is normally distributed. But it's still a simplifying assumption that we make to sort of like make the math a little bit easier and to give us some basis to form our probabilities on. Make sense?
Yep.
So estimating risk with standard deviation is a reasonable estimate, actually, as it does measure the spread of the returns distribution. So basically, when we look at that standard deviation, we're looking at the uncertainty around a measurement. So a stock price might return, monthly or something like that. But the standard deviation on that measurement might be 5%, right? So it shows that there's some degree of uncertainty around what we can expect in the future. And the more volatile a stock is, the more uncertainty there is in that measurement, and the less certainty that we can have in terms of future performance. Well, that's an estimate either way. Yeah?
Yeah.
So in many ways, that's a good estimate for risk, right? But it's largely rooted in this normality assumption when we use standard deviation or volatility, another way to say that. And that might not be accurate in practice. So I wanted to sort of contextualize that with dice. I love dice. So this is an extension of the example that's given in the book. We're going to get a little bit theoretical. We're going to get a little bit abstract. We're going to be using 6 dice, which is not actually a normal distribution, but it's pretty close to that. So in this example, we're going to take 6 dice and we're going to roll them 20,000 times. And we're going to look at the distribution of those occurrences. And when we use occurrences in this context, we're just talking about a dice roll. So when we roll it, we can get 35. When we roll it, we could get 10, 20, 25. Each of those occurrences is just a time that we roll the dice. It's an experiment. Make sense?
Yep.
Exactly. So this is a normal-ish distribution with an average sum around 21. Here we're looking at the sum of all those dice and a standard deviation around 4.2. And if we look at the standard deviation around that mean, about 70% of the occurrences are within that standard deviation range, right? And it's symmetric. So it's not exactly normal, but it's pretty close to normal. And we see that, again, the symmetry around the mean, which we also saw when we looked at this ideal normal distribution, right?
Yep.
Yep. So here we're looking at the sum of our different dice throws, and we can see that it's a symmetric, nice little range. But now let's pretend instead of having fair dice, we have biased dice. So suppose that we have our 6 dice, but some of them are kind of biased, such that 2 and 3 are a lot more likely to show up than 1, 4, 5, and 6. So instead of having 16.67 chance when you throw any one dice of getting any one number, suppose 2 and 3 are a lot more likely than the other numbers. So what I want to know roughly is how would this bias affect the distribution of dice sums? And remember, we're looking at this nice normalish symmetric distribution with fair dice, but now we have biased dice. So what would that do roughly to the distribution? I want you guys to take a second, think about it, then throw your answers in chat, how that would change the distribution of sums. If we have this concentration in 2 and 3, those are a lot more likely in our 6 dice, then we have a lot more occurrences that are skewed towards the smaller number. And so what this is called positive skew.
Okay.
So a positively skewed distribution have most of the occurrences on the negative side of the mean. And that convention is just like the side with the smaller numbers for the mean, as we call that the negative side. And then a longer tail on the positive side of the mean. So we can see that we have more occurrences over here, but then the trade-off of that is that we have a longer tail towards the upside compared to that normal distribution, again, where it was symmetric. So in this case, we're seeing the skew of the distribution, which just measures the asymmetry of the distribution, and that has certain properties. Make sense?
Yeah, makes sense. I would have thought thank you for the clarification. The opposite, maybe a positive skew going to the right and negative skew to the left.
So the way that the convention works is where the tail is. So if your outliers are to the positive side, to the larger side, then that's positive, and to the negative side, it's negative. So now let's look at another example. Very good. So now suppose we're also dealing with biased dice, but now 4 and 5 are a lot more likely than the rest of the numbers. So how would that skew the distribution, or how would that change it?
Based on the previous example, I'll say get a negative skew with a tail to the left.
Yes, exactly. And everyone, you can give your answers as well, but hopefully it's pretty obvious. But going off the last example, so now we have negative skew, so it's flipped around. So now our sums are concentrated on the positive side of the mean, but our tail is longer to the negative side. And so in this example, yeah, you have more occurrences clustered on that positive side, and you have a longer tail on the negative. That's called negatively skewed distribution. That's how we quantify that asymmetry in our dice example. So now here's the tough question. Now in both of these examples of positive and negative skew, we can see that the distribution becomes asymmetric compared to our normal version, our normal distribution, right? And you can see now when we look at the mean of the distribution and that standard deviation, we don't have a symmetric distribution of occurrences. So now here's the hard question, which is how will skew make standard deviation a less effective measure of risk or uncertainty? So this is the trickier one, but now we have more. So in this example, we have negative skew. We have more occurrences on the positive side, but then we have less occurrences on the negative side and a longer tail. What does that mean for what standard deviation? How would that change our definition? Not our definition, but the way that we might use it or rely on it. Okay, we can still use standard deviation with a skewed distribution, right? Because standard deviation still encompasses a lot of these occurrences. So it still tells us a good range of possible values around the mean, but it means we might have to tweak our expectations a little bit in terms of how we use it or what it might mean. Luis, you want to give a guess?
Well, since you have a negative skew, it will be your standard deviation. You have it more to the upside, chances for it to be on the higher range. That would be my guess.
No, you actually got it. I think you got the idea. Okay, so yep, saw that video. That's a great meme. Okay, so here we're looking at the negative case, and we want to know, okay, so in this example of the negative case, which by the way is really relevant for short options traders, we see that there's a lot more occurrences on the positive side. So that's our high pop, right? When we're trading short options, our probability of profits are higher, but our tail loss potential is larger. So when we look at standard deviation, we actually see that the upside occurrences are underestimated, right? Because it assumes that there are fewer occurrences than there actually are. But then it also underestimates tail risk, right? Because when we look at these standard deviation moves, whether that's 1 standard deviation, 2 standard deviations, 3 standard deviations, 4 standard deviations, that assumes a level of symmetry when we look at our outliers. But now, because our tail is really, really, really big, that's not necessarily quantified effectively by the Sharpe ratio, by standard deviation, by all of that. And then at the same time, in the case of probability of profit, like in our case of short options, right, is that our probability of profits are actually a lot higher than the standard deviation would imply, because it assumes that the positive occurrences and the negative occurrences are symmetric about the mean. We actually have way more positive occurrences than negative occurrences when we deal with skew in the example of short options. So in this case, we can still use standard deviation, but we need to be kind of like mindful about the drawbacks when you deal with non-normal distributions. And so to look at an actual returns example, we can see that the Q's returns distribution, daily returns distribution, has a slight amount of negative skew. So what you can see here is that roughly 53% of the occurrences are on the positive side of the mean. So we have a tendency to return positive days more often than negative days, as opposed to 50-50 when it would be symmetric. So we see a slight bias towards the positive occurrences, but then we also see a larger tail to the downside. So when we look at the occurrences that are larger, returns that are larger than 3%, that's 1.7% of the measurements. But when we look at the losses that are larger than 3%, that's 2.7% of the occurrences. So those are both small numbers, but the percentage on either side is actually, the difference is quite large on a percentage basis, right? So you can see that those negative occurrences tend to be more likely, even though the extreme occurrences tend to be more likely, even though overall the positive occurrences are more likely. We can still use standard deviation to measure range of possible values that are the most likely, but it underestimates how many positive occurrences there actually are, because it assumes that there's a symmetric distribution on either side. But yeah, does that make sense?
Yeah.
Cool. So we see slight negative skew when it comes to like returns distributions. With options distributions, it's like way more dramatic, right? So this is 20 delta SPY strangles. This is from 2005 to present. 70% of the occurrences are above the mean. 70% instead of 50, which is way, way, way bigger, right? So that's our high pop. Okay, strangle P&L is positive about 70% of the time, which makes sense with our probabilities of profits that we estimate. But the worst case loss is about 20 times larger than the largest profit that was recorded. And that tail risk, right, that's what we're seeing. It's really unlikely to get losses that are that big, but they do happen. And they're a lot more dramatic than the profits that we would see on the other side. So that's an even more dramatic representation of that negative skew that would mess up our ability to use standard deviation. So we can still use standard deviation for options P&Ls, for example, or for options or more complex strategies, but it's much, much, much more misleading than with stocks, for example, because of how distorted the option P&L distributions are compared to the normal distribution, which is an underlying assumption of using the Sharpe ratio and using standard deviation to measure risk. Does that make sense?
Yeah.
You see, risk is complicated.
Yeah.
Risk is a complicated thing to talk about, but hopefully you guys found that interesting. I mostly just liked making the histograms. I thought they were really fun. But to just kind of conclude what we were talking about, to conclude, the Sharpe ratio is a simple, intuitive metric for estimating risk-adjusted reward of a strategy or portfolio. However, one of the major drawbacks is that it assumes via the use of standard deviation that a certain level of normality is here, even though it's often not found in practice. And for next time, I wanted to maybe touch on kurtosis, which is a whole other distribution statistic, and then how do you actually statistically test for normality? That is something that you can do, which is good. So hopefully you guys found that interesting. Let me know what you think. Let me know if that you found that helpful, or if there's any other topics that you would want to see done in this kind of more workshop format.